game is afoot. If you ever watch Sherlock Holmes, you know that he says this when things are getting a little spicy, when things are getting ready to change, and you got to stay on top of it. So I thought this would be a great title for this month's quarterly market update and outlook video, because there's a lot going on and a lot is changing. Everything from DeepSeek to what's going on with the trade wars, how it's going to affect the economy, and more importantly, how it's going to affect your portfolio. And we're going to do this without all the hype and without all the bias. So let's get started. All right, let's get started with the asset class returns for the month of January. It's a pretty boring chart. You can see the month to date, or the month, 1 month is the same as the year to date. But what first stands out is you could see that everything is up, right? December we had some negative returns. There are some concerns with interest rates going up and what the trade deficit would look like and our debt and all this. And so some of that subsided this month. The economic numbers, as we'll talk about, still looked pretty solid. And we had some strong performance all across the board. But what really stands out is developed international was up over 5% for the month. Rates seem to have been kind of calming down and coming back down. So bonds were up, commodities were up as well, especially gold. On top of that, we got the trade wars, which we're going to get more into as well, that are starting to heat up. And so gold has had a nice little bump. But you can see large cap and small cap did really well. Small cap a little bit better. So let's get into a little bit more of what's going on and some of the biggest developments. All right, first let's get started with the big three economic reports. The ISM manufacturing that just came out earlier in the week was up 50.9. This is the first time it's above 50 in over 2 years. So this is actually a pretty good sign that it looks like the manufacturing part that's been kind of in the doldrums is starting to come back up. And then the ISM services, which is really the more important part of this report, the ISM services, which is 70% of our economy, was down a little bit from the previous month, but still at 52.8. They were hoping for the 54 or so, and so it is slowing down a little bit, but still in a growth trajectory. So this is almost like a Goldilocks situation where, you know, the economy is not too hot, but parts of it is starting to warm up a little bit, and so it's a pretty good setup for the Fed and for the economy here. And then just today's Friday as I'm filming this, we just had the unemployment report that came out, and the unemployment rate actually dropped to 4%. We were expecting 4.1. And so that's a decent little sign, and we had 143,000 instead of the 130 that was expected. Now the market took a little bit of a hit today in the news because we're going to talk more about the tariffs, and more tariff stuff was going on today. So it wasn't so much about this unemployment report. It was pretty benign, kind of again in that Goldilocks. Now inflation's still very important, so I want to bring this up real quick. We had the PCE core, which is the part of the inflation report that the Fed looks at the closest. This is the one that they're trying to get to 2%. And the year-over-year number was 2.8%. So you can see that's not too shabby, but we're still kind of stuck because it didn't move from the previous month. We were up 0.2% month over month, which is actually pretty good if you annualize that at 2.4. But we're still kind of stuck here. You can see on the chart that it's kind of flattening out. So we want to see that kind of continue to go down. I do think that it's going to happen because we're starting to see some of the most sticky parts of inflation starting to loosen up a little bit. But you know, if we have trade wars and we have inflation that temporarily comes back up, that could really muddy the water. So we're going to have to keep a close eye on that. All right, in the latest Fed meeting, basically the Fed did nothing. They held rates the same. They spoke a little bit on the hawkish side, talking about how Maybe they're going to pause. They're going to, obviously always say they're data dependent. They're a little worried about inflation kind of getting a little stuck here. But at the same time, still made it sound like things are going in the right direction. Although it did look like some of the Fed governors are starting to try to incorporate what could happen with the tariffs into their projections, which as you know is kind of impossible to do. But they are concerned about that, which is one of the reasons I think that they definitely are going to be on a pause here for the next few months at least. And so with that, you're going to see the market kind of go through a little bit more volatility. All right, we can't do a market outlook without talking about DeepSeek. So first of all, what is it? It is a Chinese AI model that basically copied what ChatGPT does. Okay, and ChatGPT is done by an American company, OpenAI, and they spent billions of dollars to get to the point where they are today, where you have this chatbot. Some of you may have seen this, and it's developing more and more, interesting, productive things. But the Chinese were able to do this with only about $5 to $6 million, not billion, like the American companies are spending, and they did it with all the old chips, because we can only send them the old chips because we're kind of in this AI war with them. They were able to do this with the old chips, not the advanced chips like the ones that NVIDIA has been selling here recently that can't go over there. So this has been a huge development. First of all, it's hard to know if it's for real because it's coming from China. And of course, did they really spend the money, or did they just copy and paste some of the stuff that's already been done by some of the American companies? There's a lot of questions about how legit this is. But the threat is definitely real, because think about it, if you're NVIDIA and you're counting on selling all these chips, and maybe all the companies to use AI don't need your latest and greatest chips to make AI work pretty well, that could be a pretty big threat, especially for the chip makers. But I would flip this on the other side and say, what a golden opportunity. All the companies that were using AI were basically the big guys, because they're the ones that had the billions of dollars to spend. And now you're saying that if you have a few $1 million, you can actually develop these same AI models. This could be a complete game changer for allowing mid and smaller companies that don't have the billions to actually develop these models as well. Now, again, this is all predicating that this is for real. So this is all developing now as we speak. But you saw the tech market take a pretty good hit as this information came through. It's been kind of coming back up as some doubts have been creeping into the story. But it's definitely something to keep an eye on, and a very, I think, positive development overall for the use of AI in the economy, because it's gonna get cheaper. All right, let's talk about tariffs. Tariffs is another thing that is changing the game here a little bit. Just like DeepSeek is changing the game for tech, tariffs could be changing the game for the global economy. Right now, the market is not having too much indigestion over what's been proposed so far, because it does look like what's been proposed has been taken back when there's a concession given by the other party. So it looks like, as far as I can tell, at least for our close allies, the tariffs are being used more as a negotiation tactic. So we'll have to see. You don't want to abuse that. So again, if anybody's listening out there, don't want to abuse that tactic. But it does appear that that is the tactic. And maybe the same will happen for Europe. We'll have to see, because, Trump wants them to pay more for NATO. So we'll have to see. But my concern is with China. I think with China, it's more of a true trade war. It starts with 10, and they're talking about maybe ratcheting it up more and more and more. And tariffs, the concern with tariffs, and the Fed is looking at this very closely, is if you start to increase tariffs, especially from China, because we bring a lot of things in from China, and it could potentially start raising the prices of goods. and that could potentially make inflation start to stick more or maybe even go up a little bit. And that would be very bad because the Fed right now is hoping that inflation goes down, and that's why they're talking about cutting rates. So if we have tariffs, a lot of tariffs on China, and it influences prices, the Fed may not cut rates as much, and the market would be very unhappy about that because right now they're pricing in 2 cuts for this year, and if those don't happen, we're going to see a little bit of correction. That's why I think we need to take this tariff threat a little bit more seriously than I think the market is taking it at the moment. And yes, it's going to be maybe just a one-time hit on inflation, and then the next year it doesn't make that much of an impact. But what if they retaliate? Or what if it starts to affect growth because people aren't spending as much on other things because they're spending more on these goods that used to not cost as much. But on the flip side, you could say, well, maybe we'll be making more things here in the U.S., selling more things here in the U.S., and the employment in the labor market gets better here in the U.S., and the manufacturing continues to grow here more in the U.S. So there's 2 sides to this that we have to be watching very carefully. From a positioning standpoint, more the domestic companies are going to benefit from this. The smaller and medium-sized companies will benefit even more because they do less importing and exporting especially exporting, than the big companies, and so they would benefit potentially from these tariffs. But I think as we try to digest what's going on here, there's going to be a little extra volatility here over the next few months. All right, so finally, the Heartwood implications. I am not pressing the panic button quite yet. On the last video, I talked about how I was bullish, but I am playing it very slow in the transition into adding a little bit more in the small caps, from shifting from growth into more value. So kind of slowing my roll there again, but still moving in that direction. We actually saw this month that small cap started to outperform the large cap. And I'm also continuing to add to more corporate bonds, floating rate bonds, as interest rates get kind of stuck here a little bit, not going down quite as much, although fortunately we saw a little bit of that reprieve here in January, shifting a little bit from cash. Again, not in a big rush to do that, but still for the long term, because you got to look at this stuff in the long run. The short run is way too hard to predict with much accuracy. I'm still bullish about things because there's more than just tariffs that's going to be happening this year. There's also going to be tax cuts and deregulation that would be very pro-growth. So over the full year, there's still a lot of good things to be potentially looking forward to from an economic standpoint, which will help the stock market. All right. I hope this helps, guys. If you have any questions, which I'm sure you do because there's a lot going on, please feel free to reach out to me. I'm always happy to talk to you, discuss this more, and also feel free to share these videos with your friends and family. That's why I put these together, so you can share as well. Thanks a lot, and God bless.